Today we're doing a deeper dive into Alphabet stock, also known as Google, ticker symbol GOOGL. On the screen here, you can see a snapshot right out of their 10K from 2022. Their revenue streams include Google Search, YouTube ads, Google Network, which make up their Google advertising business. In 2022, they did about $224 billion of revenue for Google advertising. Other areas of the revenue streams are Google Other, Google Cloud, Other Bets, hedging gains and losses. In total, they had $282 billion of revenue in 2022. Currently, Alphabet is on Forbes' list as being number 2 in the entire world with most valuable brands. Some of those brands include Android, Gmail, Chrome, YouTube, Workspace, and YouTube TV, among many others. In fact, Google and YouTube are the 2 most visited websites worldwide, followed by Facebook and X. So this is a very, very valuable company sitting at about $1.5 trillion of market cap currently. Next, let's take a look at Google's 10-year financial history, and it is very impressive to say the least. So their enterprise value has grown from $293 billion in 2013 all the way to $1.6 trillion here today. As far as sales per share goes, they've grown at $4.13 from 2013 all the way to $22.96 the trailing 12 months. That is equivalent to 19% growth per year for sales over the last 10 years, 18% for 5 years, and then 19% on a 3-year CAGR basis. Earnings per share has grown from 95 cents in 2013 all the way to $4.83 here today. As far as CAGR growth goes, that's 18% EPS growth over the last 10 years, 17% for 5 years, 17% for 3 years. Very, very impressive and correlates very closely to sales per share. Free cash flow per share, also very impressive, going from 84 cents back in 2013 to $5.64 here today. So free cash flow per share has actually grown faster than sales and earnings per share. So that is a 21% CAGR growth over the last 10 years, 28% over the last 5 years, 21% over the last 3 years. Book value per share has grown also quite a bit, but not as fast as sales, earnings, or free cash flow, growing from $6.50 of book value back in 2013 to $21.19 here today. So from a CAGR basis, that is 13% 10 years, 11% for 5, and 9% for 3 years. Return on invested capital has been very impressive for investors. So most investors have bought into this stock, have done quite well over the last 10 years. Over the last 10 years, ROIC has been about 16% on average. Last 5 years, 20%. 3 years is 23%. Now, these debt areas over here correlate to the balance sheet. I always like to know that the company has low debt, also has plenty of current assets to cover current liabilities, and we are seeing that. So EBIT over net debt / operating income over net debt is negative. That is an indication that net debt is actually negative after looking into it, which means they have more cash on hand than debt, which is tremendous. If we move over to debt over equity, right now they're at 11%. The highest they've ever been is at 13%. They've been all the way down to 2%. Really, any company that is under 50% is doing quite well. So seeing these low of numbers with debt over equity is very, very impressive, especially for a company at Google size. So they're doing very, very well. They have very little debt compared to equity and even operating income. Current ratio is sitting at 2.2 right now. It tells me that they have twice as many current assets as current liabilities. It's been all the way up to a 6 back in 2016. So they've averaged over the last 10 years 3.9, 2.8 over the last 5, and then 2.5 over the last 3 years. So that is very impressive as well. Now, as far as a market multiple across the board, on average, the market has been willing to pay a 21 over the last 10 years, 22 over the last 5, a 20 over the last 3. Gross margins have been anywhere from about 54% all the way to 62% over the last 10 years. Currently, they're at 56%. Now, as far as operating margins go, they've gone from anywhere from 22% all the way up to 31%. These also have been very conservative over the last 10 years, ending about average 26% over 10 years, 26% over 5, 28% over 3. So overall, when I look at these numbers, if I didn't know this was Alphabet, I would say right off the bat, this is a tremendous, tremendous company. Seeing these growth numbers over the last 10 years and being as big as Google is, it's really, really impressive that they can keep up these numbers even the last 3 years. One area I'd like to see them grow even more would be book value per share. I'd like to see that very consistent with sales, earnings, and free cash flow. So that is a bummer, telling me that equity hasn't grown as much as maybe those other metrics that we've looked at. But nonetheless, Google is doing very, very well. Now let's jump over and take a look at what analysts expect this company to do over the next 5 years. So last year, like we saw on the 10K, the revenues were at $282 billion. This year, analysts think they're going to come at $304 billion. So they grow to $339 billion on the top line next year, and then $377 billion the year after that, $415 billion in 2026, and then $450 billion in 2027. That is a 10% CAGR growth. So over the next 5 years. Now, net income, they believe is going to grow 18% per year. Operating income is going to grow 15%. Free cash flow is going to grow 14%. Cash from operations is going to grow 14%. And then EPS is going to grow around 18% per year. So again, even though the company has done very well over the last 10 years, analysts do expect that's going to continue to do well, growing double digits. Something that stands out to me, though, is that analysts think that sales is going to drop. The company has seen close to 20% growth on the top line. They think it's going to drop down to 10%, but net income, earnings per share is almost going to grow double that going out into the future, according to analysts. The first valuation template we're going to take a look at is the margin of safety calculator. So I have $4.80 as a normalized EPS for Alphabet. I think the EPS is going to grow around 17% per year over the next 5 years. Analysts think it's going to be around 18%, but I'm comfortable with 17% from what I've seen, with a rate of around a 3, which gives me a target buy price of roughly $119. Today, the stock is trading at $139. So this valuation template is telling me that it's not necessarily a buy right now. The next valuation template we're going to take a look at is a discounted operating earnings model. So with this, I am suggesting or assuming, believing that the company is going to grow revenue on the top line about 12% per year over the next 5 years, which is a little more than what analysts think. So I think you're going to be around $305 billion this year, $345 next year, $395 in 2025, $450 in 2026, and $505 in 2027. Again, that's about a 12% growth on the top line. Now, we did see sales per share growth almost at 20% per year over the last several years. Now, as far as operating margin goes, or operating earnings margin, right now I think they're going to be about 27% this year. I do think they're going to get up to around 30%. At one time they were around 31%. So I do think they're going to become more lean as time goes on. And that's going to come from cloud and other aspects of their business. So I do think that 30% operating margin is attainable for Google a few years from now. Based on the information and coming up with a market multiple of 24, I usually don't like using this high of a multiple, but I do believe the company's going to continue buying back shares like they've done over the last 10 years. So I'm willing to have a higher multiple in this particular case. And Google's just such a great company. I get an intrinsic value of $143 here today, which is very close to what the stock is trading at here today as well. Now let's jump over and take a look at a 10 cap valuation. So this one, I'm trying to calculate owner's earnings of the business, and I don't want to pay more than 10 times that amount. So I think operating earnings of the business right now, or free cash flow, is going to be around $75 billion. If I take that, also add in the tax provision of like, I think a normalized amount is around 12.5 billion, divide that by shares outstanding, I get a 10 cap valuation of roughly around $70, which is half what the stock price is here today. So 10 cap valuation, I'm not too surprised since Google has had such tremendous growth and the market multiple is fairly high, even from a historical standpoint. So the market has been willing to pay a premium. So I doesn't concern me, or I'm not surprised that the 10 cap valuation is much lower than what the stock price is right now. Next valuation model I want to take a look at is the payback time calculator. So this one, when I buy into a company, I want to get my money back within 8 years. This model specifically looks at free cash flow. And I believe, just like the 10 cap valuation, I think a free cash flow normalization for Alphabet is around $75 billion. I think the growth rate is around 15% per year for free cash flow. So that gives me a payback time of about 10 years. I want to see it under 8 or less. Since the market pays on average a multiple of 16 across the board, historically over the last 100 years, if I can buy into a stock and get my money back within 8 years, that would be a good indication that the stock is undervalued at this time. So this model tells me that the stock is not undervalued as it currently sits. So let's summarize all the valuation templates real quick. So the discounted operating earnings model, it came with a fair value of $143 with a buy price of $100. So that is a 30% margin of safety there. Payback time, buy price would be $94. 10 cap, buy price would be $69. The margin of safety calculator buy price would be $119. So if I look at all these, none of these actually indicate it is a buy right now. In fact, my discounted earnings model suggests that it's trading at fair value right now. Last but not least, let's take a look at return on investment, what I would expect to get from this stock based on the assumptions and the forecasts I did earlier. Keep in mind, you should know how to value stocks yourself and make your own assumptions. Just don't go off what I'm saying or other people on YouTube say. If you don't know how to value stocks, I do offer valuation templates on my Patreon. I'll put a link down below if you want to go check that out and support the channel. But if you take a look at this, if the stock price, let's say, was $143, I would expect a 10% return on investment for the stock over the next several years. Whereas if the stock dropped down to $94, I would expect a 20% return per year over the next several years. Keep in mind that I believe sales is going to grow around 12% per year. I think operating earnings is going to grow around 15% per year, and I think the market exit multiple will be a 24. Thanks for sticking all the way to the end of this video. If you haven't already, please like the video. If you like this kind of content, I encourage you to subscribe to my channel. Again, this was Alphabet stock, ticker symbol GOOGL. If there's another stock you'd like me to do analysis on, throw it down in the comment section below. Love to hear from you guys down there. Thank you for watching again. Take care and God bless.